Hello and welcome to the Canaccord Wealth Coffee Break podcast. My name is Jane Parry and I am the Chief Marketing Officer here at Canaccord Wealth, and I'm delighted to be joined today by Tom Hibbert from our Chief Investment Office. So the idea behind this podcast is to have a little look in a bit more detail at the commentary we write on a weekly basis in our weekly markets review, and that's sent out on a Monday every week to the subscribers of that newsletter. So we want to dive deeper into some of the more interesting areas to get a better understanding of what's going on in the markets. The idea is grab a coffee, listen to this once a week for about 10 minutes. Without any further ado, let me welcome Tom.
Morning all.
Morning. And as it is a Canaccord Coffee Break podcast, what is your coffee of choice, Tom?
I like a strong coffee, strong Americano in the morning. I've got two little toddlers, so quite sleepless nights. So I need a lot of coffee to keep me going. So strong Americano in the morning, move to espressos in the afternoon typically.
Caffeine or decaf?
Oh, caffeine. 100%.
Caffeine all the way. Yeah.
What about you?
Yeah, I'm a black coffee kind of girl as well. Yeah, Americano. But yeah, I do caffeine all day too. Keeps me going. Right. Anyway, let's move on to some of the details that we're going to talk about this week. So this week, Treasury Secretary Scott Bessent published a paper entitled The Fed's New Gain of Function Monetary Policy, which I thought was a particularly catchy title. It sheds light on the current US administration's assault on the US Central Bank, or the Fed as we know it, the Federal Reserve, and the belief that they have overstretched their role, which has had a significant impact on the world. So, Tom, first off, I wanted to ask you, where does this term gain of function come from?
Many people have probably heard it before from COVID.
Yeah, I had heard it from then.
So it's a scientific term. When a virus or gene mutates, it gains a new ability. So it could be infecting a new species, spreading faster, resisting treatment. It's controversial in a lab sense because although you gain insight, you also risk unintended consequences, like a pandemic. So it works really well as a metaphor here for the Fed.
So just in the financial context, sort of quite simply, can you just give us a little bit more about what are the specific policies that we're talking about that have extended the Fed's remit, if you like?
Sure. So the idea previously was that monetary policy should always be conducted with caution, restraint, humility, because the decisions that they have such significant consequences and long-term consequences as well. You know, allegedly, according to Scott Bessent in this paper that he's written, those ideas were abandoned during the global financial crisis. Yeah. So prior to then, the role of the central bank was to maintain sort of moderate interest rates. They have this dual mandate to control inflation and target full employment, but they also could provide some liquidity during any sort of crisis to stabilize the market.
Okay.
During the GFC, they stabilized the market.
GFC, a global financial crisis. Yeah.
They used this sort of liquidity, these asset purchase programs to stabilize the market. But then they also started to use huge, excessive asset purchase programs to provide stimulus. So not just about stability, but also stimulus. And they tried to steer the global economy rather than simply stabilize it. So they've started to overuse and overstretch those non-standard policies.
Right.
So particularly quantitative easing.
Yeah, okay.
And the problem is that expanded toolkit, QE, it wasn't fully understood. So if you look at Ben Bernanke, for example, Fed chair during the GFC, in 2014, he said, and I'm quoting, "The problem with quantitative easing is it works in practice, but it doesn't work in theory."
Okay, so what did he mean by that then?
He meant that it wasn't fully understood, the
repercussions of what they were doing. Okay.
Exactly.
So that's what Bessent is saying is their gain of function.
Exactly.
Yeah. So you touched on severe economic distortions as a result of this activity. Who's actually benefited from this? What actually has happened?
Yeah, so it's a really important question. So Bessent points to the fact that the distributional effects, basically who actually benefited, is incredibly asymmetric. So what we know now, looking back, is that QE clearly inflated asset prices, but there's not a huge amount of evidence that it led to an increase in actual economic growth. So when the Fed comes in and buys trillions of dollars of bonds, it forces prices higher, it makes those bonds less attractive, and then investors are forced to buy riskier assets, equities primarily.
To get the same level of return.
Yeah, exactly.
Yeah.
And so this whole era of the post-GFC era, sometimes people call it the TINA trade. So TINA stands for there is no alternative, and there was no alternative to equities. So a 2017 study that Besant points to suggests that the impact of QE on asset prices is 10 times the size of the impact on economic growth or economic output.
So is that because the bonds became unattractive, it forced people into equities, supply and demand, price of equities went up?
Yeah, prices of bonds went up because there was a price-insensitive buyer, which was the Fed.
Right.
And then because bonds were unattractive, because prices have risen, and also bond prices feed into equity valuations, it forced prices of risky assets up.
Okay.
But also you had things like the Fed was very persistent at jumping into the economy during at the first sign of crisis. So markets call that now the Fed put. So basically they came in with this big liquidity bazooka. to fight any crisis, and that meant it's led to this idea that effectively what you have is socialism for investors and capitalism for everyone else. So that's what's contributed to incredible inequality. It's only become worse actually now because we've had this spike in inflation and we've had to have higher rates on the back of that, which have had an outsized impact on smaller companies and lower income echelons of society.
And it's having social repercussions as a result.
Exactly.
Yeah. So just looping back to what the US administration are doing and what Scott Bessent is saying, how does this link through to the Fed's independence and credibility? What's the story there? Why should we be concerned about that?
The Fed stepped quite far outside of its lane with this relatively strict and well understood tools that they had. And they started to drive the economy, steer the economy more explicitly, and arguably made some policy errors, quite a few policy errors on that path. It's left them more exposed to politics. So we're seeing that now. So there are accusations of political bias, which has created flaws in their economic models, and we can give some examples of that. Bessent gives some examples of that. Then there's now pressure over who sits on the FOMC, who sits on decides monetary policy. Yeah. And questions over its independence as well. So Bessent argues that its credibility has already been eroded, and that's dangerous for investors who rely on policy stability. Okay,
and I guess that administration has only got a short period of time to take action to rectify things as it sees it. All this activity is now going on.
They actually have until the end of February, because what they're trying to do is gain control of the FOMC now.
The FOMC being
the open market committee that decides makes monetary policy decisions.
For the Fed.
Yes, so they're trying to oust Fed Governor Lisa Cook, who allegedly has committed mortgage fraud. They've installed Stephen Moran, a fascinating person who, in my view, is the chief architect of Trump's economic plan.
Yes.
Not a well-known figure, but he's really responsible for, in my view, the Mar-a-Lago Accord that is driving a lot of Trump's policies. If they get Lisa Cook out by February, they will then have a sort of Republican majority of Fed governors on the FOMC, and they'll be able to steer monetary policy. And then there will be that sort of the independence between the Fed and the government that's already become clouded will become more transparently tied. So
it's a really interesting one, isn't it? Because when you read the headlines, it sounds like Trump is putting his people in. But actually what you're saying is almost the opposite of that. He's trying to reinstigate much more independence of the Fed back to their core values, their core purpose.
There's two ways to look at it. So that definitely what they want to achieve is less experimentation, more conventional policies, more focus on their dual mandate, and they also want a leadership team that's more aligned with Republican policy priorities.
Okay.
They say that previously they've been more aligned with Democrat policy priorities, and I think there's some evidence for that. But more open debate on the FOMC, less tolerance for mission creep. There are a lot of positives that I think they want to move forwards with the Fed in terms of what they want to achieve. So it's a balanced picture, I would say, but in my view, tilting more positive.
And can I just ask, in terms of thinking about our clients and investors, why should we be worried about this? Why is this important? It's the US, it's the Fed. It feels a long way away from us. How is this impacting what we're doing on behalf of our clients?
The Fed sits at the heart of the global financial system. It's effectively the global central bank.
Okay.
So its decisions have a vast and lasting impact on financial markets and the global economy. So it's absolutely key to understand these dynamics.
Yeah.
And, the more the Fed's credibility is questioned, the more volatility that you might expect in financial markets. And we should expect the outcome of this battle for the Fed will have vast implications for all of us, and the global financial system and political systems as well, how monetary policy works with fiscal policy. So it's an incredibly it's a current issue, but has very long-term consequences.
Very long-term
and
consequences.
We need to understand the dynamic.
Yeah. But potentially positive for investors, as it may redress that balance around independence and credibility, and therefore perhaps longer term, but more stability.
I think so.
Well, thank you very much. Thank you for your time today. I have learned a lot over my quick coffee in the Canaccord coffee break. So in my takeaway cup, I learned a lot about gain of function when something acquires a new ability it did not have before. In this case, we were talking about the Fed. And initially their gain of function stemmed back to the global financial crisis. And the result of that seems to have been a massive impact on bond and equity prices, but little impact on real economic output, which is worrying. And even 18 years on, we're still having the repercussions of that. And the current situation will have very long-term consequences, but would appear to be redressing that balance around independence and credibility. And we can only think that's going to be a good thing long-term for investors.
I think that's absolutely right.
Thank you very much indeed. Thank you very much for your time. Thank you to everyone who's listened and has got to the end of the podcast. If you have any feedback for us, this is quite new, so please let us have that feedback. You can email us at coffeebreak@canaccord.com. So coffeebreak@canaccord.com. And we look forward to talking to you again next week. Thank you
very much. Thank you.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.